Howdy, Jacob here. Today we're looking at the Vita Coco Company in the beverages industry. We're doing a one-off video today. 1.3 billion market cap, just under 1.2 billion enterprise value. They develop, market, and distribute coconut water products under the Vita Coco brand name in the US, Canada, Europe, Middle East, Africa, so pretty much globally. It's a plant-based energy drink, ever and ever. Okay, incorporated in 2004, so fairly newer company and definitely newly public. We see that we just have about 5 years of data to work with, but we are seeing very impressive growth figures here. Gross margins are up from 5 years ago, and operating margins up from 5 years ago. Return on invested capital looks fantastic. Looks like they do a great job of the money that's reinvested back in the business. Their balance sheet shows 133 million cash on hand with no short-term debt, no long-term debt, 83 million total liabilities. So very impressive there. Cash flow statement shows weird years over here where change in working capital they had a problem with, but on a 5-year average basis, fairly solid production of free cash flow. Looks like they've been buying back a little bit of shares with their excess money, otherwise just increasing that cash position. So the only thing that's troublesome about data where there's only 5 years is that it's kind of tough to really see what the company does with their free cash flow. I do like a long history of, do they buy back shares consistently? Do they buy back shares when it's stupidly cheap? Do they just pay a dividend? Are they really good at reinvesting back in themselves? And I just don't see that plethora of history here to where I'm able to identify that. But I do think that based on their revenue growth and everything, I can make assumptions to possibly, be able to forecast with as much accuracy as I can. I know that a lot of people are going to be a lot better at forecasting this little data than me because they are going to look into this company more. For me, I do like initial analyses to just be on numbers because I want the valuation to be so obvious that it forces me and really pushes me to do more research. And so, unless it's saying that it's a screaming deal, why would I waste my time and not look at other companies that might be way better deals? That's just my perspective. Everyone does differently, but that's just the way I do things. On the revenue growth side, I do think that they do have abilities to reinvest. I do think that there's acquisitions that could make a lot of sense for them. I think I would not be surprised with an 8% revenue growth year over year. They're still a pretty small company. The beverages industry is absolutely massive. Are they able to disrupt it? Possibly, but for me right now, I think that's the number I'm most comfortable with. I think I would not be surprised. I don't think I'm going to go with the averages here. I'll probably go with the higher end because they are a newer company. I do think that they'll find more consistent margins, but I think 10 and 12, somewhat of a range there. Share repurchases, they've historically bought back some shares, but not really in excess of their stock-based compensation, so I'll probably say that that's relatively flat. The P, again, tough because I don't necessarily see the premium. I do see growth premium, which is great, but I don't necessarily see moat premium with all this data that we have. And so maybe 18 there, 15% return. And I'm saying it needs to fall a little bit more in half than where it's at right now. I think that companies that have a long runway of growth ahead of them, I think can get you a fantastic rate of return, even buying at a price that doesn't necessarily look attractive. Because you have to think about it. If a company's able to grow 10 to 12% revenue growth, or even 10 to 15% revenue growth a year for the next 20 years, you don't have to buy it at the perfect price today because it's going to have expansive growth throughout that time. And so if they're reinvesting everything back into themselves to get that rate of return, that's fine. But there's also different avenues because there's 5 things you can do with your free cash flow. Maybe they're paying a little bit out in dividend, so you get that money right away to do what you want with it. Maybe they're buying back shares when they know that they're stupendously cheap, or they're dollar cost averaging, like what Google has done historically, Apple, Microsoft. Some of the big dogs have kind of just bought back 1 to 3% of their shares a year. Maybe they'll buy back three if it's really cheap, one if it's looking a little bit expensive, and really you're just going to get the return that the business gets. And so I think that through share repurchases and through reinvesting back into yourselves, I do think that if there's a long runway of success and you are able to identify those companies that have that really long runway, then I think you're going to do a great job, and you just need to be patient. And that's the best thing to do in your circumstance. For me, what I like to do is look at a bunch of businesses and try to get the best return possible and allocate a lot of my money in not a whole lot of companies. I do like diversification, the fact that I know that I will be wrong more than or as much as I'm right, pretty much. I think that the historical track record for a very good investor is 60%, and for a very solid investor is like 50% correct. And so, really, I think even to have those 1 to 5 companies that does extremely well, you're going to get 10 to 20 that do okay, and then maybe 5 to 10 that just don't do anything. But those 1 to 5 that you can really get those very long runways, very good returns for a long period of time, and you don't trim it. I know this was I don't know who said it first, Peter Lynch or Warren Buffett. I want to say Peter Lynch said it first, but um, he just never understood why people would trim the winners of the year and then flood money into the losers, because you're basically watering the weeds and ripping out the plants. And if you give the plants time to grow, they can grow beautifully into these historical, fantastic rates of return rather than just taking all your money out of them when they do really well and reallocating all your money. Just let them sit. It's the coffee can approach. It's the Hunter Baker approach. You just kind of wait and let the company do what it does. But to do that, you do need to have a very good understanding of that business, and not just that business, the industry business or the industry that the business is in. If you are the best company in a crappy business or in a crappy industry, I don't think you can absolutely have fantastic investment opportunity. And I'm not saying that I think everything that produces positive free cash flow is worth something and can be a great investment. But I think the best thing to do is buy a growing business in a growing industry that you are confident in and have a good research of that business and the industry into, where if the business is growing or the industry is growing 10 to 12% and your business is growing 12 to 15% throughout a 20-year period, that's going to give your company a great moat and is a fantastic investment. And so I know I just had a quick one comment. So that's just where I've been just spewing all this information from, or the reason why I'm spewing it. But in short, on the cocoa uh, business that we're looking at here, it does look a little expensive, but I did just want to go over some high level thoughts on investing in companies that can give you a fantastic rate of return that you just have to be patient on and let the business ride what it rides. And that's where Charlie Munger's quote of buying a fantastic business at a good price is better than buying a good business at a fantastic price. And I think that's going to give you the 100 baggers that you're looking for. I don't think that, buying a good business at a fantastic price is necessarily going to give you a 100 bagger, but I do think that if you don't have a lot of money, then you have a lot more companies to look at. Whereas Warren Buffett, with his hundreds of $billion, isn't going to be looking at some of these sub $5 billion companies. And so we do have that advantage over him, and definitely not the sub $1 billion companies, because 10% of that is 100 million, which to him is not worth it to invest in. And so all that said, I do hope you enjoy the video, and I do hope you have a fantastic rest of your day. Thank you so much.